Hello, everybody. My name is Gilinski, and I'm the CEO and founder of Brickell Analytics. Brickell Analytics is a global macro research firm based on technical analysis. We have an abbreviated presentation today, so abbreviated time window. So we're going to try to go quickly through the presentation to be able to have enough time for questions at the end. Our research service is comprised of two different models. One model is technical and discretionary in nature. The other one is quantitative in nature. Part of our quantitative in nature models is to measure the speed of the S&P 500. And by speed, we mean momentum, how fast the market can go up or how fast the market can go down. When the market gets to extremely overbought territory because it's been up a lot, then it tops, reverses, and goes down. And conversely, when the market is very oversold, and on the velocity or the speed of the S&P is the velocity of the S&P is very low, the speed is very high, the market bottoms and goes up. Today is a timely day to make a presentation because the velocity of the S&P is on very high. It's near 50 according to this table. So the market is extremely overbought. When the market gets extremely overbought, it churns, tops, and then goes down. And then we're going to use this technical indicator to put it into context of on a wave pattern that we've been discussing here over the last 12 months. So we came in March of last year, and we said we spotted what was called an ending diagonal pattern in the S&P. Ending diagonals are just patterns that are formed over a long period of time by two lines. So if you look at this chart, since March of 2020, when the S&P was at 2,200, the S&P started rallying, and the rally has formed what was called an ending diagonal pattern, because we can chart it with two lines. And as the market goes further higher, the diagonal pattern forms like a triangle, and it gets smaller and smaller. At one point, the market tops or ends, and it breaks outside of the diagonal pattern. So we came here in March, and we said, look, the market is forming an ending diagonal pattern, but it may take another 6 months to top. Then we came back 5 months later in August, and we said, it's closer to topping, but it hasn't topped out yet. And then in November, we said, look, the market has topped and it's going to go down. Although the S&P did not top in November, most of the most other major indices or stocks topped in November, like the NASDAQ 100 or Microsoft. The S&P ended up topping, about 6 weeks later on January 4th. And then it topped, it broke outside of its diagonal pattern and went down 15%, as you can see in the chart. The market is already below the diagonal pattern. So now that the market is below the diagonal pattern, what is the forecast? So what we believe right now, the forecast is that the S&P staged a 15% decline between January 4, 4,800, and February 24, which is about 4,100. And since February 24, the S&P has been rallying in what we call a wave two up. Wave two up is a counter trend bounce that offsets the previous sell-off, but the counter trend bounce, it never really takes the market above its previous record high, which in this case is 4,800. So we believe the market is topping, or should top here around 4,650 to 4,800. And once it tops, then it should go down. And what will be the biggest leg of this declining pattern, which we call a crash leg. And because the market formed an ending diagonal pattern since March of 2020, ending diagonal patterns, once they complete, the market returns to the point of origination. The point where this pattern started was 2,200 on the S&P. So we think the S&P is on the verge of going down a lot, to about the 22 to 2,600 range. The VIX should bottom above 15. It's currently around 18, 19. And once the VIX bottoms, it should begin to surge together with the market. We're following the Dow. The Dow should top around 36,000, a little bit below the all-time high, which is about 37,000. The Russell 2000 is bouncing. The bounce in the Russell 2000 should end, between 2150 and 2300. Same case for the German DAX. German DAX staged a very significant decline between the November high and the March low. And now the DAX is in a bounce wave. Once the DAX finishes bouncing, it will reverse and go down. And then this is a market that we want to emphasize today, or an index that we want to emphasize today that's very important. The QNET index. The QNET index is an internet-related business index where companies that do commerce over the internet form part of the index, and they're usually the largest. They're the largest companies. So the QNET index dropped about 45% between February of last year and March of this year. It was a large drop. And so now the QNET index should rebound, finish the rebound, and then reverse and go down about 50%. PayPal is a large component of the QNET index. We think PayPal, dropped 70% between July of last year and March of this year. PayPal should bounce and should stage a large bounce. Our minimum downside target for PayPal is about 150, but it can get up to 200. And once the bounce in PayPal exhausts itself, then PayPal will reverse and go lower. And the QNET index, together with some of the members that make up this index, are good stocks and an index to monitor that will give us a sign on when the market is going to get ready to turn lower in the next decline of what we think is a bear market. And we're going to explain why we think we're already in a bear market in the slides going forward. So the 5-year Treasury note yield is at about 258 basis points. And Treasury yields are currently topping around current levels. And if you look at the 5-year note, it's about 258 basis points. But if you look at the 10-year note, it's at 247 basis points. So something odd is happening right now. Right now, you're basically getting paid more money to park your cash in Treasury yields that have less duration. So for a lower yield, for less duration risk, you'll get higher yield, which makes no sense. 258 basis points for a 5-year note versus 247 basis points for a 10-year note. So the spread between the two notes is already negative. It's at about negative 10 basis points. And when spreads on yields go negative, it's usually a sign of recession. Why is it a sign of recession? Because if the economy is in a healthy state, longer term bonds should always have a higher yield than shorter term bonds. But in this case, shorter term bonds have higher yield than longer term bonds. And part of the reason is the Fed is raising rates right now, but then the market doesn't think the Fed raising rates is going to be beneficial for the economy, and the economy in the end is going to end up, topping out and then contracting. So short-term rates are very sensitive to the Fed funds rate, to the Fed and the Fed raising rates and the Fed funds rate, and then longer-term rates are very sensitive to the direction of the economy. And if the economy contracts, then we go into a recession, which means the stock market goes down. So in this case, the yield curve has inverted. The spread between short-term rates and longer-term rates is already negative. This is hinting at a recession. The recession is kind of imminent. It's going to happen at some point between now and the next 6 months, but we're going to get what's going to lead the market into a recession is the S&P 500 topping below 4,800. Second to last, there's a pattern that we spotted a long time ago, almost 7 years ago, in the dollar yen. The dollar yen hit a high in June of 2015 at almost 126. Then the dollar yen went down fast around the time of Brexit in 2016. It kind of bottomed at about 100. And then the dollar yen never really breached below the 2016 low that it hit in 2016. And instead, it kind of formed what's called a triangular pattern. And then these triangular patterns, usually when they complete, lead to another leg higher. And that leg higher is usually a final advance. So dollar yen formed a triangular pattern between the high of 2015 and then the low right after COVID in 2020. And then it broke out of the pattern really at some point last year. And then the dollar yen should top above 125. A rising dollar yen can be, the dollar yen can rise primarily because interest rates are rising. And then when interest rates stop rising, the dollar yen tops and goes down. So this dollar yen market is also telling you that it's corroborating what we're seeing in the rates market, which means we think yields are topping here at between 250 basis points and 300 basis points. The yield curve is already inverted, the spread is negative, so we're going to go into recession. And then the dollar yen is finishing its breakout pattern at about 126, 130, and then it should reverse lower together with equity markets in what's called a risk off wave. So if the dollar yen reverses, interest rates go lower, markets go lower, what's going to happen to oil? Well, we think oil topped at about 130 on March 7th. It went down from 130 to about $94. It's bouncing now between 95 and 115, 120. And once oil finishes the bounce, it should go down together with equity markets in what we think will be a deflationary collapse, as opposed to stagflation. So we think markets are going to enter recession, yields go lower, equities go lower, commodities go lower, dollar goes higher, except against the dollar yen, and then we have, you know, a deflationary unwind similar to 2008 or the 2011 time period in Europe. And that gets us through the end of this presentation. So I would like to open it up to questions. And we have about 15 minutes for questions.
Okay, if you have questions, please put them in the Q&A section. What do you think the time horizon is on this, Isaac?
Time horizon on what?
The market correction.
So the market should start to drop lower once the S&P finishes its advance, or what we call that wave 2 up bounce. So the faster the S&P goes up, the sooner it will go down. So right now we think the S&P is topping right here, 4650, 4800, and if it tops over the next 3 weeks, then, you know, we should see a significant drop starting in mid-April. So we just got to monitor right now the extent of the current advance and whether or not the market tires right here. And the way we measure whether the market is tiring or not is
so Isaac.
Yeah, 1 second. So we can measure the speed of the S&P. So right now we know the S&P is very overbought because the speed of the S&P is near 0, the velocity is near 50. So we're monitoring this indicator, and once the indicator starts to turn down, where the velocity of the S&P goes down and the speed of the S&P goes up, we know the market is changing direction and is going from up to down. And that, together with the upside target of the S&P, whether it's 4650, 4700, or 4800, will give us a hint as when the drop is going to happen. So right now we think at least we have another 3 weeks of bullish upside price action and churning, and maybe, you know, by mid-April the market could turn down, but things can change.
All right, great. Isaac, there's a lot of questions. We have a really good audience on today. Thank you so much for coming back and talking to us about technical analysis, Elliott Wave, and Brickell Analytics. Can you tell the people on here today a little bit about your subscription service, how much it costs, and how they can subscribe to it?
So given we're at a very important juncture in the financial markets, in the global macro markets. So this is a setup we haven't seen since maybe 2008. And because we have a great relationship with Flya, and Flya has been very loyal to us and has allowed us to, you know, market our service throughout the years. We agreed that we were gonna And because we're at a very important juncture, we agreed that we want to give all Flya subscribers that are interested in subscribing to our research service 50% off the annual subscription price. So we're not going to discuss how much the service costs, but you're welcome to send us an email, and then we'll give you more details of the promotion that we're offering to Flya subscribers and to the participants that are on this call.
Okay, very nice, Isaac. Thank you so much for that. And with the subscription, what is it that they get?
They're going to get a weekly report that goes out on the weekends with our charts. That goes out once a week, 4 times a month. And then we're going to send out a daily email with a signal on the S&P, a signal on oil, and the velocity of the S&P as measured by this table, to give you daily insight as what we think is happening on the markets. The daily report is all quantitative. It's generated by a machine. We don't have anything to do with it. And then our weekend report is the charts. So that's what goes with the subscription. You're getting about 6 emails from us on a weekly basis, about 24 emails per month.
All right, great. And with regards to the daily emails, it goes into velocity and then extremely overbought, mildly overbought, neutral, mildly oversold, extremely oversold. If I'm trading, how do I factor in that information into my decision-making process?
And remember, we also have a quantitative model on the S&P and on oil that gives you daily signals on the direction of the market. And primarily, you got to follow these signals instead of trying to either you follow them and trade them as they come, or you put them in the background and you incorporate them into your charts. But I think this is, once a subscriber comes on board and he wants further explanation, we'll be happy to do a conference call with you to explain it. I think it's harder to explain right now, in a more generic presentation.
Understood. But I actually like that part of it, because I use you as a piece of my decision-making process when I'm buying or selling something. And you and I have become very good friends over, the last decade or so. And I've seen you in up markets, down markets. And what I know when I use your service is it's purely technical. And I'm not getting Isaac's fundamental biases inside of, this chart that you're showing right here. So that's pretty much how I see a great amount of your value is you're giving people a unbiased technical analysis, and it doesn't incorporate how Isaac feels on a specific day. So for people making decisions, you can count on Isaac, you can count on Brickell Analytics to tell you what the technicals are saying, not what way the fundamentals are blowing. So if you're interested in fundamentals, this isn't the right service for you. If you want a technical perspective, he publishes a report. I would say it comes out maybe 5, 6 o'clock each day, Isaac?
The signal comes out after the market closes every day, and then on the weekends we send a weekend report, which can come anytime between Saturday and Sunday. I think we have a lot of questions, so we want to speed this up because I don't think we have a lot of time, right?
I know we don't have a lot of time, but I want to make sure people understand what Brickell Analytics actually does. So with regards to the weekend report, what is it that's inside of the thing? What do you have inside of the weekend report?
The weekend report has charts that look like these.
Okay, so
they cover the 4 sectors of the macro markets. The macro markets are divided into 4: foreign exchange, equities, interest rates, and commodities. And you can throw Bitcoin into the FX part. So we do Bitcoin work as well. And then we do charts, about 20 charts across the global macro spectrum. And we write some commentary and tell you where we think the markets are going over the next, few weeks, couple of weeks.
All right, so you're guiding people on the weekends what to look out for what's coming up. just a couple more quick things with regards to, the subscription service that you have. How long have you been publishing this weekend report?
11 years. We started the service in February of 2011, so 11 years.
Have you missed sending out any of the weekend reports in 11 years?
No, we have not.
What edition is it at?
Like 4,700 or 47. Yeah, 47, above 4,700. We've done 4,700 issues.
You have 4,700 of these cataloged?
Yes, we're almost at 5,000, correct.
And how much do you incorporate fundamentals into the weekend report?
Zero. There's no fundamentals.
Oh my God. So I can rely on Brickell Analytics to give me the technical look.
Yes, we're purely market technicians.
All right, that's great. And you get a 50% off by going through Flyer to subscribe to his service. So please, I encourage you, if you're interested, definitely put it in. I buy it. So what sectors would you want to be in as the bottoming occurs?
When the market bottoms, I mean, you want to buy equities again, right?
But what sectors inside of equities?
No, I mean, you buy the S&P 500. If the S&P 500 goes up, everything goes up, right? You just gotta watch. You just gotta watch the market, the technical levels.
All right, let's
say we have a big drop in the S&P going to 2,200, then you want to watch markets get to their 2020 lows, and once the market gets to its 2020 low, then you can buy anything that is at that level. Is what we think will happen. Some markets are already there. Like if you look at like PayPal, the low in PayPal in 2020, I think was $80 around there, and we got to 92. So this stock is just very oversold no matter what. So whatever is close to its 2020 low is an undervalued market. And whatever's trading at a significant premium over its 2020 low is overvalued.
So Isaac, that did not answer the question. The guy's looking for sectors. Why do you prefer the S&P over the sectors inside it that may add alpha?
I mean, there's only 4 sectors. There's S&P, there's treasuries, right? There's commodities, and there's foreign exchange. I think your biggest return is in equities.
Got you. So this is macro, and Isaac's focused on the S&P. That's his, he chooses what to play and he chooses what not to play, but he has focused on the S&P for over a decade now. All right. So this guy wants to know what's your rationale for this massive collapse. Be specific and don't give any frothy answers to this question, please.
We already answered that. I mean, I already went over that. That was, a significant part of our presentation. I'll be happy to, say it again. The S&P formed an ending diagonal pattern between the March 2020 lows and the January 2022 highs. It broke out of the diagonal pattern. It's in the chart here, right here. It's already outside of it. And then these diagonal patterns are reversal patterns, they're ending patterns, and then the market returns to the point of the origination of the pattern. The pattern originated at 2,200, hence the S&P has to go to 2,200. It's a rule, it's an Elliott wave rule. This is the rule, you can read it. And all we're doing is acting as weatherman. We are just interpreting the pattern, we spotted it, and we're just telling you, hey, here's the pattern, and we're reading the rule, and this is where it should go if the pattern is correct and the rule is correct. So I can't really address that any further than what we've already been saying for over a year.
So look, that's exactly what I'm trying to get through. The point that I'm trying to make to the audience today is if you're looking for somebody to tell you, that there's another wave of COVID coming that's going to cause lockdowns and earning compressions, this isn't the right service for you. You shouldn't be listening to his predictions. He uses wave theory, which has a very, very it has a philosophy in it that things get overbought and oversold. And, you know, Isaac, like, just tell us, you think there's a chance the rally to the new high in the S&P was a B wave and the diagonal lower was a C, that completed a correction. Is there a case for you that we make a new marginal high?
Well, if the S&P right now, you got to monitor the S&P. It's at 4,600, 4,650, wherever it is, right? So what we think is happening right now is the S&P is on a wave C of 2 up. Wave C's of 2 ups have only one requirement, which is the market cannot rally above 48.18. If the market rallies above 48.18, then we're safe. Then the market is not going to crash right now, right? And it's better for everybody, right? We don't have a market crash. The can gets kicked down the road for a few more months. However, because we think we have started a crash pattern in January, we should be on the alert for a reversal down in markets before the S&P gets above 4,800. So again, we are weathermen. We're like, you know, for those of you that live in Florida, you know, you get hurricanes primarily in August, September, and October, and you turn on to the weather channel, and the weather tells you, the weatherman tells you, look, there's a Category 5 hurricane coming. And if they're accurate, you got to leave South Florida or you're going to get hit by the storm. This is the same thing. We think there's a market crash coming, Category 5 hurricane coming. We're the weathermen. And of course, if we get above 48.18 on the S&P, this is going to be delayed. It's not going to happen. But from what we're seeing right now and for the evidence that we've been gathering for FLIA members since March of 2021, we think the market is on the verge of a very big decline. And the rates market is already confirming it because the spread between Treasury yields is already negative. The yield curve has already inverted, and that's a very reliable signal.
All right, great. Hey, Jim, long time, you know, listener, long time subscriber, you know, happy that you're on today. And I want to make sure we answer your question. He said, great analysis. Another EW Elliott Wave analyst thinks we go to SPX 5,500 first, but he FC 55, then crash and panic. He first called 5,500, then crash and panic. Have you seen any of your, you know, some of your like colleagues calling for a higher high?
I don't want to get into that. We don't really look at other people's work, and we don't really care what other people are saying. I mean, we do our own work, and our work right now is generating a crash pattern. And if the S&P rallies above, as I said, we're getting into a repetitive cycle. If the S&P gets above 4,800 and it rallies to 4,900 or 5,000 or 5,100, then great. Then we've kicked the can down the road a few more months, and the market is going to crash later. Great for whoever's making that market call, right? If we get above 4,800 on the S&P, right, and we break above that level, then we're going to reset our pattern. But right now, there's no reason to reset our pattern, and we're going to be bearish because the S&P has what we think has broken outside of an ending diagonal pattern. It went down very hard into January. Some other sectors went down even more. And now this seems like a counter trend rally, a fake bounce. And we'll just got to wait and see over the next few weeks. This pattern is going to clear up.
Isaac, we still got people coming in and joining us at this point, but we're out of time today. And I'm sorry we didn't get to all your questions, but it's always great to have you back on. You've been a longtime supporter of FLIA, and we appreciate that. So thank you all for your time today. We hope that Isaac answered a lot of your questions. And if not, please get in touch with us. So we
for the questions that haven't been answered, and I see that there's a backlog in the Q&A, if you want to send us an email at outreach@brickellanalytics.com, outreach@brickellanalytics.com, we will try to answer all the questions that were left unanswered in today's report.
All right. Thank you all for your time and your attention. You can do whatever you want with your time, but you choose to listen to us today. So for that, we're grateful. Have a great day. Bye now.